Hey traders, Jason here from Levitt Brothers. Hope you're having a good weekend. In this video, I'm going to do an update of my state of things. 2 weeks ago, I ended my video by saying the following. If the indicators shown here can hold their current levels, they'll look more like May, not like the previous fall. I also said for all that is bad that's going on in the world, for as bad as the news headlines have been, the market is simply trading in a range. If it can absorb so much negativity without being damaged too much, then we have to respect its resiliency. Okay, so despite the volatility in August and the gaps and how bad the media was leading people to believe the situation was, I was somewhat warning that the market was actually holding up pretty well. And if it continued, the path of least resistance would be up, not down. I followed up the last day of the market video with doing a video on YouTube which I titled, "Is the stage set for a monster rally?" Okay, because I was seeing growing evidence that not only were things getting less bad, but they're actually starting to get pretty good. So today I want to cover the breadth indicators, talk about what I saw in the charts that led me to believe that the market wasn't in bad shape and instead was likely to move up. And even if you didn't catch the rally over the last 2 weeks, this will be educational. You'll be ready to go the next time this sequence plays out. All right, so let's check out some charts. All right, so here is the S&P 500. Up top, we have the 10-day of the 80 line in the middle. We have the traditional 80 line down below. All right, so let's review a few things. Okay, so when the market goes, let's change colors here. So when the market trends up, we get the 10-day of the 80 line tends to hold at a pretty good level, mostly above zero, sometimes below. Okay, so what happened there? Then we got a trend up here, and the 10-day held up above zero, and then we got another trend up here, and again the 10-day held up above zero. Okay, now let's zoom in a little bit closer. Get another color here. All right, so as this moved up here, we got a pretty obvious divergence, and then obviously you see that the market fell apart. The market moved up here at the last bit, we got a pretty obvious divergence, and of course the market dipped. And then as the market moved up here, we got a pretty obvious divergence and the market dipped. Okay, so all three of these started out the same way. Then things changed. Okay, as you can see, last September, October, you had a bigger drop below zero. You had a recovery, but then back below zero, and an attempt to recover, and then a bigger drop below zero. Whereas in May, all we got is a relatively shallow move below zero, and then a recovery. Okay, so in August, when the market dipped here, and this indicator dropped here, I was asking myself, is the current situation more like May, or is it more like last fall, October, November, December, when the market completely fell apart? Obviously, it was much more like May, which is one of the reasons why I was telling people, hey, as bad as things are, they're actually not that bad. Don't get too bearish here. And we got a recovery, and of course, the market did recover too. If you look at the cumulative line, obviously there's a big difference here. Last fall, the 80 line dropped below its 50 and actually trended down, whereas in May, all it did is drop to its 50, a little bit below, and then it recovered, and then in August, it dropped, did a couple touches along its 50, and then continued up. So again, I was asking myself, is this more like May, or is this more like last fall? Obviously, it was more like May, which is why I was only expecting just a shallow drop and then a recovery. I wasn't expecting a full-blown correction. All right, next group of charts. These are the large cap AD line, mid cap AD line, small cap AD line. Okay, let's compare them. Last October, November, you can see I'm going to start with the mid caps. We had the line move down, sideways, and move down. Small cap AD line, down, over, down. The large cap moved down, kind of recovered a little bit, but then down to a new low. If you compare that to May, when the market pulled back a little bit, all we got is just a little dip and then a recovery, and the trend actually stayed up. Okay, mid cap line, dip, recovery, trend was in place. There was no lower, no lower lows, no lower highs. Same thing in with the small caps. We just kind of traded in a range. Okay, so as the market was unfolding last month with the large cap AD line, all it did is drop back down and start to recover. Mid cap line drop back down, start to recover. Small cap line dropped back down just into its range, started to recover. Again, I was asking myself, is the current situation more like May, or is it more like last fall when the market fell apart? Obviously, it was much more like May, which is why I was expecting the market would recover and not completely break down. All right, here is S&P 500 up top. We have the NYSE new highs in the middle and the new lows down below. Okay, so similar to the first chart, let's okay, so we have when the market does well, as it did here, here, and here, what we got is you get new highs printing at a decent level. Like boom, new highs printing at a decent level, new highs printing at a decent level. Okay, last fall, obviously the market broke down hard, okay, but it's not, I mean, this is not that much different than this, and it's not that much different than this, okay, so they all started out the same, but the difference here is new highs dropped to really low level here, okay, you see that? Whereas in May, all they did is dip here, okay, right here they just dipped and then recovered. Okay, so you can see a big difference here. They all started out the same. All of them just kind of fell off the high. Boom, boom, boom. They all look the same. But then in October, things got really bad when the new highs printed a low level and tried to recover a couple times, but then fell back to a low level. Whereas in May, it just kind of dipped and then maintained its level. So again, in August last month, I was asking myself, is this more like May or is it more like last year? And with the new highs just simply dropping and then recovering, obviously the conclusion was this looks a lot like May. So I'm expecting, a pullback, maybe a basing period. As volatile as the market was, we had a lot of gaps, a lot of intraday reversals, a lot of relatively big trending days. As bad as things were, the indicators were telling us that this was more like May than last year. So I was expecting a recovery, and that's exactly what happened. Let's look at the next chart. Similar here, we have S&P 500 up top, the NYSE high-low differential down below, and then the cumulative high-low differential. All right, so when the market, we have strength here, strength here, strength here. Oops, that's a big line, whatever. And what you get here is you get steady prints above, steady prints above, steady prints above with some dips below. Okay, they're allowed to dip below. Okay, so in all cases, uptrends are characterized by the high-low differential kind of rolling up and down, mostly above zero, sometimes below zero. Not a big deal. All right, so then what we got here is the last bit here. We got a very obvious divergence there. In fact, you can see if you look closely, like the S&P is like, whoops, that's not what I want. Right over here, the S&P is at its high, and the high-low differential is already below zero. So there's a little bit of a warning that something's going on here. Compare that to May and the most recent time period where we're at the highs, and the high-low differential was at a high here, and the high-low differential was at a high here. Okay, so that was one little warning. But obviously, there's a big difference between once I made the point before that like the beginnings of these drops, this one, this one, this one, they're all the same. They're close enough to being the same. But in this case, we got the high-low differential drops to a very low level, tries to recover several times and just can't. Whereas over here, we just get like a moderate drop, but down, fairly shallow. It's not a big deal. And then it recovers. And so in August, when we got a drop down, I was asking myself, is this situation like this, or is it like this? And obviously the answer is obvious, and you can see what happens. That's why when everyone was kind of in panic mode in August, I was saying, hey, it doesn't look that bad. Okay, I'm not so sure I want to, be aggressively long here other than a couple of the leading groups. But I wasn't expecting the market to completely break down. All right, two more charts. They're very similar. Okay, what we have up top is the S&P 500. Down below is the percentage of S&P stocks above their 50-day moving averages. Okay, similar to before, similar to previous charts, we got a trend up, trend up, trend up, And these trend ups are accompanied by prints with mostly above the 55% level, which is about right there. Okay, so when the market's strong, you get a lot of prints above 55%. Okay, then what happens is you get a, market drops here, market drops here, market drops here. They look very similar, but last October we got a big drop, little double bottom, 2 attempts to recover, and then another big drop. Compare that to May, where we got a little double bottom and then a recovery, and that's it. We just got a recovery. It didn't get rejected by the 55% level. It just simply recovered. So as the market was weakening in August and bouncing up and down, first thing I noted was the fact that it only fell to here, which was similar to here, not down here. So right off the bat, as bad as things were in August, I was saying, hey, they're not that bad. And then I was thinking, okay, this thing can recover. Is it going to get rejected here, or is it going to go straight up? And obviously what happened is it's gone straight up. So again, another situation where market breadth was telling us that the August weakness was much more similar to May and much less similar to last fall. And so far, so good. We've gotten a nice recovery. All right, last chart. This one is the percentage of stocks above the 200-day moving average. Okay, so we got uptrend, uptrend, uptrend. Okay, so last year, so uptrend's accompanied by prints above, mostly above 50%, which is what we got back here. Obviously, market falls apart here. This dropped to a really low level, based, and then dropped to a really low level. Compare this to May, where we got just, almost as much of an intense move down at the beginning, but this simply just rolled down to the bottom of its range, 50%, and then it recovered. So in August, when we got this drop, I was noting that, hey, all this thing did is roll down to the bottom of its range at 50% and then recover. Obviously, this looks a lot more like this and a lot less like this. So I was expecting, when I was expecting the base to eventually resolve up, which is exactly what has happened. Okay, these are the indicators that I noted at Levitt Brothers for our subscribers, where I warned them that, hey, as bad as things seem to be, they're not that bad. So, lots of people make predictions. I don't. I just follow the market's internals. Like, they pretty much can't lie. Okay, if you have a certain amount of stocks that are moving up versus moving down, or making new highs versus making new lows, or trading above or below certain moving averages, they can't lie. Okay, like there could be a little fuzzy area around the edges, but for the most part, like, they are going to be very accurate. Okay, in my eyes right now, the market is in good shape. I fully expect the S&P and the Dow to hit new highs, and for the small caps and mid caps to make legit runs at their own new highs. All right, thanks for listening, and I'll see you next time.